You're listening to The Whole Truth, a Resources Rising Stars podcast.
Hello and welcome to this very special episode of The Whole Truth podcast. I'm Paul Armstrong. We're coming to you today from the lovely Raw Pines Resort on the Gold Coast, where the annual Resources Rising Stars Investor Conference is about to get underway. We have nearly 800 investors registered to attend over the next 2 days to hear presentations from more than 50 companies. This conference is now in its 22nd year, and one of the reasons it proves so popular to our investors is that they get a rare opportunity to speak directly to those running the companies. Of course, that's an opportunity afforded to fund managers and professional investors every day of the week. But retail investors so rarely get the chance to talk directly to those with their hands on the levers. So this is what this is all about. One of the questions we often get asked at Resources Rising Stars is, what do some of these mining terms mean? They hear people say these phrases regularly, they read them in article releases, and they ask us, what do they mean? So we come up with this idea for a masterclass of sorts, Mining 101. Of course, as good luck would have it, this happens to be the 101st episode of the Whole Truth podcast. So we put this together and said, hey, why don't we have Mining 101? What better timing than to have it at the start of the Resources Rising Stars conference on the Gold Coast? So here we are. Now, this little episode is about explaining some of these terms. So if you think that diamond drilling is about looking for expensive gems, or perhaps you think the Lawson curve is an inappropriate expression you might hear in an investment bank, or perhaps you think strong recoveries refers to the ability of your managing director to bounce back after a big night, then this is for you. That's why we're here today, to answer some of these questions. And we've lent on some of the best resources head business to help us on the way. I'd like to introduce them to you tonight. The first one, Chris Cairns, known to so many of you in his current role as Executive Chairman of Staveley Minerals. Chris, of course, was a driving force previously at Integra Mining. What you probably don't know, that Chris is a long-standing member or director of the JORC committee. Now that sounds rather boring, doesn't it? The JORC committee is the austere group that decides what companies can and can't say in their ASX releases. So Chris is well across that detail. We also have Simon Lawson joining us, known to all of you from the fantastic success he generated at Spartan Resources, and I know so many Rising Stars investors did so well out of that, and you can hear the clap you're already getting, Simon. Simon's going to help us particularly with some underground mining terms, because he was a senior executive at Northern Star before he made his name at Spartan. So we're looking forward to hearing from Simon on that. And of course, another person well known to us at Resources Rising Stars in his current capacity as a fund manager and managing director of Lion Selection Group, Hedley Widdup. Again, you might not realise that Hedley in a previous life is a geologist, and Hedley worked on site at many sites in Western Australia for a long time, and he was an analyst for his sins at one of the big broking houses. So there's probably not much left in this business that Hedley doesn't know. So we're going to get the game underway now. And Chris, I'm going to start with you, because one of the most common expressions that we see in ASX releases is that it's open at depth or open along strike. Can you give us a succinct understanding of what does that mean?
Sure, certainly. Initially, you get a drill hole into an ore body, and yes, it's euphoric. You start to flesh it out. You start to expand the scale of it. You're drilling a long strike down depth. A long strike means sort of longitudinal as you follow the lode, if you will. At depth or down dip means going further down. When you have not closed it off, you continue to get more grade, either a long strike or down dip. It means that the ore body remains open. You haven't closed it off. It's still going.
Right, thanks Chris. Now let's move to the other end of the spectrum, to Simon. I did mention strong recoveries in there, and I wasn't talking about you. But you do see these expressions in headlines a lot. Why is it so important to have strong recoveries, and what are they?
Well, I had a good think about this question. Recoveries can refer to a number of different things. I suppose if you look at it from a mining perspective, recovery from a mining perspective is your efficiency in recovering ore versus waste, or your dilution that you're getting from underground. Most people think about recoveries in terms of their processing or milling recoveries, when it's the efficiency of the recovery of gold, or how much gold, or the percentage of gold that goes into the plant that you get out in your concentrate or into your gold bars.
Okay, so often, Simon, we see it in respect to metallurgical recoveries, strong metallurgical results. Can you just elaborate on that a bit? And I know that often people say That is the lie detector. What actually happens in the metallurgical tests?
Well, most people will build a bench test that represents the type of plant or the flow sheet that they're going to put in place to process whatever material that they're mining, and then they essentially make a scale model and then use that as a proxy for what it's going to look like when you scale it up. But I can say, and I'm going to speak freely here, is that a lot of these metallurgical recovery and test work numbers, the companies will always look to try and promote the most agreeable ones and tuck some of the other less agreeable ones into the back. So always have a look and be, discerning when it comes to not just looking at the headline.
Now, going back to the intro, Hedley, it falls to you to give us an appropriate, politically correct explanation of what the Lawson curve is.
You've put me on the spot there, Paul, because I don't really like being politically correct, but if Simon's going to speak plainly, then so shall I. So the Lawson curve is named by or after Pierre Lassonde, a famous mining investor, prospector, and geologist from Canada. He headed up some very large companies, was involved in the founding of Newmont, Franco-Nevada, etc. And he described the evolution of value from a company before it's discovered anything right through to the point when it's in cash flow. And it prescribes a pathway which is euphoria, down in the dumps, and then reflecting true value, if you like. So the evolution, to describe that in sort of layman's terms, is before a company finds anything, it's worthless. They don't have any assets other than a hope and a dream. You put a drill hole into something that looks exciting, a high-grade mineable width result, and the market starts to speculate. And it's not unusual for share prices to run quite strongly from there. So share price charts going up steeply. That's the start of the Lawson curve, going up into the discovery mound, if you like. You come over that, and typically you round off the top where the share price starts to soften when you say, right, I think we've found it all. We've published a resource. We're now going to study it. And when you start studying a deposit, the good news stops getting bigger. It starts getting harder. You start talking about metallurgical recoveries and how deep you've got to dig and what it's going to cost. And investors tend not to flood to that kind of thing nearly as much as they do for something where you're still finding it. After it's funded, financed, built, share price eventually approximates the point that reflects how much cash they're making. So you go through the full evolution from discovery, euphoria, studying it, starting to get a bit boring, reaching cash flow, we can value it at a point now. And it's describing the whole value of the company, not necessarily the share price.
Now, Chris, one of the things we're going to hear over the next couple of days a lot is obviously talk about drilling results. And in discussing those, we often hear the expression 4-metre composites. What does that mean?
Yeah, look, as an exploration geologist, really what you want to do in terms of your targets is you want to cover as much territory as cheaply as you possibly can. So you come in with a relatively cheap drilling technique like rotary air blast, acronym RAB, or air core, and you punch as many holes as you can over as wide an area. You're throwing a large net. In a cost savings exercise, what you do is that the samples are laid out in piles. Often you see these photographs of next to the drill rig and you see the different colored piles in the countryside, normally 10 or 20 in a row, 10 or 20 meters. To save money, instead of assaying every single meter, you composite 4 meters together. And then
so you aggregate them?
Aggregate them, just use a little scoop, put them all into one bag every 4 meters, send it off to the lab. So when you report those results, so the good thing about a 4-meter composite is that it's the gift that keeps on giving, because you report the 4-meter composite, but then you send the fieldies back out into the field to sample the 1-meter piles as well. And then you get the lab results from the good 4 meters, and you can report them as ones. So you get a lot of mileage out of it. But the truth is, it's because you want to cover as much ground as quickly as you can for the least amount of cost. You composite samples.
These managing directors are starting to sound a bit promotional, aren't they, Paul?
I wouldn't know what you mean. Now, Simon, this is probably the most commonly asked question we get, and I have to say, I don't think I could provide a 3-sentence answer to this, so it falls to you. What is a stope? What is stoping? And why is it considered to be, when companies say we've started stoping, why that's considered to be such good news?
Okay. When I first arrived in Australia in 2005, I didn't know what a stope was. I was just a green-eyed geologist from New Zealand, had to learn all these things. So I feel like I did learn, and I'll get to the last part because it's important. Everything is about trying to get to production. Production has the lowest cost of mining. Development has the highest cost of mining. So this is from an underground perspective. If you're developing out your ore body, and I'll use an example that people know well, is Never Never is being developed right now. It won't move into production until there is at least 3 or 4 levels open. And production is when you actually create a stope, which is where you drill up holes from the development drive. You put along your development drives along the ore body, and then you put up holes in with a long hole rig, which basically means you drill up to at least 25 to 30 metres to the next level spacing, and then you drop all of that out by firing it and letting gravity pull.
So you blow it up and let it fall.
Correct. That's the cool part, where you start taking that economies of scale approach to these ore bodies, and you're letting gravity do all the work.
So it's a process of extracting the juicy part
Correct.
of the ore.
That's when you really start making margin.
But in an economic sense, it's the point in time where money stops going out the door and starts coming in the door.
Well, that's the plan, isn't it?
Yeah.
It doesn't always work that way.
Or if it's Never Never, you're making money in the development, and then the stopes are just gravy.
Now, Hedley, another one that we will hear at times, particularly from those explorers who consider they've got something very good on their hands, is the expression ounces per vertical metre. Good luck with this one.
So, particularly with gold, it's a simple commodity to do economics on the fly. People tend to talk about ounces per vertical metre in gold as a rule of thumb of, is there enough gold density in this ore body to sponsor development? And without doing the whole set of economics of what shape you need to mine, how are you going to process it, how much is that going to cost? I think for a very long time, people who've been operating in gold have realised that if every vertical metre of the ore body contains 1,000 ounces of gold or more, 1,000 ounces per vertical metre, that's a useful rule of thumb. If you're above that, you should do okay. You should be in business. Now, there's going to be plenty of examples where you can't, plenty of examples where you do. Typically, if ounces per vertical metre gets better and better, it's a signal that it's quite a useful ore body. Simon, are you at liberty to say what Never Never's ounces per vertical metre would be in the juiciest part?
Over 6,000.
Yeah. So,
but sorry, I'll just jump in there because it's an interesting statistic that I always look at. Ounces per vertical metre in the ocean is actually higher than any ore body I've ever mined.
dissolved gold
Correct.
in the ocean.
Correct. The ounces per vertical metre is huge. And I don't say that, well, I do say it facetiously, but if you look at some ore bodies, they can quote high ounces per vertical metre, but you've got kilometres of scale that you're going to have to expend cost over. So in general terms, it's useful as a benchmark, but there are some pretty wild examples that aren't.
So its limitation is, without going too far, 6,000 ounces per vertical metre is a tremendous density of gold within a mineable shape, in my book. I think things like the Super Pit or the Golden Mile in Kalgoorlie go about 50,000 ounces per vertical metre. And so if about 1,000 ounces per vertical metre is a good rule of thumb, 50,000 is well over that. Now, the way you can do this yourself is, if you say to the managing director or look at their presentation, can I just see a picture of your resource on one page, and I want to know how deep it goes, and I want to know how many ounces there are, and then you just divide one by the other and coming up with that number. Now, it's going to be very, very, very aggregate. It's not going to be accurate, but if you're coming up with a number like 10,000, go back and ask more questions. If you're coming up with 200 to 500, move on, find something else.
I do that myself. Exactly what you described. That's my first pass.
Now, Chris, this is getting right into your geology textbooks here. We often hear companies talk about an intrusive related gold system or an intrusive system. I think one great example in more recent times is the Hemi discovery in Western Australia, obviously De Grey, now taken over by Northern Star. Yeah. And I suppose given the amount of money that's been made off the back of that, it's no wonder that exploration companies love to highlight the scope for an intrusive system. So what is an intrusive system?
Sure. So everyone knows a granite's hot, it comes up and intrudes, rises through other rock types. So a granite is an intrusive. Generally speaking, the intrusives that create ore bodies like Hemi are smaller, quite hybrid chemical compositions, but that they're carrying a lot of metal. And so the classic intrusive related deposit would be a porphyry copper deposit that you would see in the Andes in Chile or Peru, for example, where you've got a subducting ocean crust creating a mountain chain full of volcanoes. So that's the classic intrusive related style of deposit. But Hemi, quite an old deposit in the scheme of things. It's not a new volcanic arc or anything like that. But the beauty of intrusive related deposits is that typically they do have scale potential, and hence, really the plus 10 million ounces of endowment that we know of.
Why do they have scale? What makes them so attractive from an investor's
because it's a
perspective?
big fluid system. So you've got a heat engine, which is the intrusion itself, but you've got a lot of fluid circulating around it, and it's got, in particular chemistries, it's got an amazing metal carrying capacity, and so they can carry these fluids entrained in hydrothermal fluids up into levels in the lithosphere that they can form really big metal deposits, just because they have so much energy involved in so many metals in their budget, if you will. Yeah.
So while we've got you on the spot then, how does this compare to an epithermal system?
So epithermal, if you think about, again, that Chile, Peru, continental margin where you've got a subducting oceanic slab, you've got the deeper porphyries. So porphyries as an intrusive related deposit you might think of as forming between 2,000 and 5,000 meters below surface. Whereas as you get further above that, they're still sort of heat driven, but you're starting to entrain some meteoric waters, or waters that are surface waters that are coming down into the system and mixing with metal rich fluids. And they're mixing at much lower temperatures. So instead of the porphyry where you're probably looking at, let's call it 450 degrees, 400 degrees for a porphyry, these epithermals you're forming, potentially some of the New Zealand examples, you might be at 150 degrees if you're really in these champagne pool type centers, or a little bit deeper down, you might be, 200 to 250 sort of degrees. So they're much higher level, much cooler. But again, in those particular systems, you can get extreme grades, particularly for gold. You start to lose the copper. It's a hotter type of mineral deeper down, and gold becomes more dominant in those shallow levels.
Sorry, can I just jump in there?
Sure.
Epithermals to me have a really unique mineral assemblage too, which is important, I think, from an investment perspective, because they can carry a lot of different metals that can be advantageous, but also deleterious as well.
Yeah. So mercury, for example, or arsenic, and some of them antimony. So antimony back in the day was a pain in the arse, quite frankly, but now it's considered a critical mineral and is well sought after, even though there might be 3 off-takers in the world, and they're all in China.
Now, while we're on the heavy geological terms, Simon, this is the one that I really want to hear an answer to. What is the meaning of structurally controlled?
That wasn't the question you sent me.
I said I'd send you some questions. I didn't say I'd send you all the questions.
It was
Do you want a hand?
No, look, I'm good with it. I just thought that Paul was being very clever when he asked me this question. What isn't structurally controlled?
No, what is a structurally controlled system?
Of course. Look, I'd have to say, and I was going through it with Glenn from Mammoth earlier, structure pretty much plays a part in every gold system. In most mineral systems, there are some examples that are not directly related, but structure plays a massive part. And I've always been fascinated by the lack of structural understanding that some companies have when they're out there talking their wares. And it's not having a crack at people, it's just that I think that if we understood the structural framework of our gold systems particularly, that there would be a lot more along strike and down dip, open at depth, open along strike being talked about. I think there's a few people that use too many open arrows, but it is a fundamental of most systems. I mean, that was one of the reasons why we looked where we looked with Never Never and then back into the open pit that was Dalgaranga, was because we looked at it from a structural point of view. We learned what Never Never looked like, and then we thought, well, what if we apply that same framework back into what had previously been mined? with that in mind, and it just fell into place. And then we looked at 65 kilometres away at Mount Magnet, and the exact same structural framework exists. So it really is quite, wouldn't say simple, but when you crack that code, you can really start to accelerate.
Is it fair to say structure results from rocks being deformed, changing shape, and a structure is typically a breakage of some sort?
Yeah.
And you need the breakages to either transport or to deposit.
And sorry, like absolutely, that is a fundamental understanding. And sorry, taking it for granted there. Structure is about creating a break that allows for the transmission of fluid to a trap. It's no different to oil and gas in a way that you create a hydrocarbon and then you transmit it to a horizon where it's trapped either by a impermeable layer. It's almost exactly the same.
It's one of the three key elements: metal source, plumbing system, and means of depositing the metal.
Now, Hetty, talking about putting people on the spot here, a little bit more subjective here. One of the phrases that we often hear is "grade is king," and I suspect one of the most overused phrases in the mining lexicon is high grade. Now, I have to say, when I was a young reporter starting out writing about resources, I considered high grade was anything sort of from 5 grams onwards. Now, obviously the world has changed and a lot of these deposits have been mined out, but what do you consider to be a fair grade to be described as high grade, and is grade really king?
That is such an open-ended question, isn't it? In every ore deposit, there is things that are considered high grade, but I think if you cast your mind across the entire gold mining universe, you know, the genuine high-grade deposits need to be averaging probably 5 grams a tonne or more to be considered properly high-grade. Now, there's a lot more that contributes to the economics of a gold deposit and whether it's going to be successful or not than just grade, although I'm sitting next to someone who I've had arguments on LinkedIn with about... and sometimes it's just easiest when Simon makes a comment on LinkedIn that you don't agree with to send him a laughing face rather than to actually answer it. But
that hurts so much. I'd rather have an argument than an emoji, mate.
Yeah, so cool.
I was promoting one of our investments, which is quite low grade, and I was making the point that because there's so much of this low grade ore, you can apply bulk economics to it, which gives you a very attractive cost profile. And now that contains a whole different set of risks from, say, underground mining. Underground mining is something that requires grade. I think that's fair to say. And if you have a great, big, fat, high-grade underground deposit, that is one of the most juicy things in terms of producing economics. But where I think this breaks down and gets misused is when people are announcing things and saying, I've got a high-grade result here, and it's like 30 centimetres thick and it's 5 grams. Because that might make for a beautiful hand specimen. And as a geologist, I would look at it and go, okay, that is lovely. I'm enjoying looking at it, but it's never going to make any money with that sort of geometry, 30 centimetres thick, and that sort of grade. So at 30 centimetres thick, you probably need 100 grams.
But let's admit it, there's quite a bit of hyperbole in the whole sector and promotion. You know, the catchphrases that I hear, world-class, tier one, you know, if it was tier one,
have you never used that before?
No, I refuse to use those terms.
All right, well, you're probably one of the only MDs around.
But the truth is,
if
it were world class or tier one, BHP and Rio Tinto would be knocking on the door. If they're not knocking on your door, I think you're stretching the truth a bit.
Right. Now, one of the questions I'd like to put here is, how many of you have heard this phrase EV and EV per resource ounce? I've got a few knowing looks there. So, Hedley, this is going to fall to you, but chaps, feel free to wade in here because it's going to be one that's going to crop up over the next couple of days. How do we calculate an EV, and therefore, how do you calculate an EV per resource ounce, and why is that meaningful?
Yeah, I had an argument with my wife about EVs before I left home, but
it's because I don't wrong EV.
Yeah. So enterprise value, EV, is the total value of a company. By the time you take out all of the cash products and debt. So if you take the market capitalisation of a company, you add the debt that they have, and then you subtract the cash, then you have the enterprise value. You've got the value of the projects within it by saying, what's it worth? Take out the cash and that's it. And then there's a very common metric which gets bandied around, and this is, you know, there's no two gold companies the same. In fact, there are no two gold ounces in the world anywhere, except once they've been probably processed and put in a pile. gold that's in the ground, there are no 2 ounces that are the same. They'll all produce a different margin, if any. But a very common way of comparing companies is to say, well, how big is their resource and what's their enterprise value? What's the size of the company? And the reason you need to use EV is because it's not correct just to use market cap. So you could say market cap per ounce, but you would have some cash in there, which has got nothing to do with the gold. And you might have some debt in there, which you need to include as well. So if a company is trading at $50 per ounce of gold in the ground, they would probably put forward an argument to you that they should be more valuable than that. Without finding any more ounces, you should just pay more for the company. That's what they're saying. If they're trading at $5,000 of EV per ounce, well, they're trading at the price of gold, aren't they? So they should probably be a bit cheaper than that. Either that, or you can imply that the market is saying they're going to add more gold ounces to the pile. So it's a reasonably useful metric in that you can compare 2 companies and but once you've done it, you then need to explain to yourself why one is high and one is low. You can't just imagine that one is going to approximate the other naturally.
Now, Simon, moving to the processing area, refractory gold, we're seeing more of it. Again, years ago, it was absolutely toxic in an ASX release, wasn't it? It was the dreaded R word, but obviously science is changing, the nature of deposits is changing. It's not seen to be the big problem that it was.
And I think the gold price going up is also having a massive impact on that, is that people are becoming more accepting that there may be some refractory component. Refractory is, I think, used incorrectly in a lot of ways. It is used as a blanket term for a lot of different problems that can occur with gold systems particularly. I suppose on the face of it, refractory is, it is a characteristic of an ore that using typical free milling type CIL gold plant, very simple sort of setup, that you won't be able to liberate enough of the gold because of some characteristic there. It then is applied to deposits that have arsenopyrite, that have other chemical reasons for why there's difficulties with recovering, and that's more of a deleterious issue because arsenic creates an issue with the gold processing itself, but it doesn't stop you from getting the gold out in most cases. So if I sell my concentrate to someone with a ton of arsenic in it, I'm going to get discounted price for my gold, not because I couldn't get the gold out, but because it's got arsenic in it.
So is it economic death?
It's not economic death. It probably surprises a lot of people, and I'll get the number wrong here. Hedley probably knows it off, the back of his head, but more than 60% of the world's gold is produced from refractory deposits by some of the biggest gold miners in the world. So it's not something to be scared of. It's just when you're a small company, it's a cost problem, and
you have to allow for it.
Correct, and it's always about cost. We talked about high grade just before. If you look at high grade as an offset to costs, that's the right way to look at it to me, because underground needs plus 5 grams because of the increased cost over open pit mining. That might be 2 grams. And the world's changing all the time with the gold price, but also costs are lifting with inflation. Power costs particularly are keeping pace, especially in Australia.
Now, Chris, the cut-off expression, everybody says that a cut-off. Let's have a quick discussion about that, because it's often cynically received, isn't it? Suddenly a company reports a big increase in their resource or reserve, and in the fine print they've actually lowered the cut-off. The famous desktop review, as they say. Yep. What is a cut-off, and do you think sometimes it's a bit conveniently used and abused?
Yeah, look, that is a fraught issue.
You're asking a JORC committee member.
Yeah, well, I was...
And that's why I asked him.
I was going to say, for the audience, the last review of the JORC code was 2012. We're currently reviewing it at the moment, and look, if we're lucky, I think we'll get it out for 2027. And there have been changes in the code, and one of the key changes is what we refer to as reasonable prospects for economic extraction, and this relates directly to cutoff grade. So effectively, sensu stricto, in an economic sense, your cutoff grade needs to reflect your marginal cost of production. So you add in your mining cost, your processing cost, your overheads, and you say, okay, that equates to a break-even grade of, let's call it at the current price, let's call it for an open pit 0.3 of a gram. So if your lower cutoff grade, if you mine 0.2, you're going to lose money. So you don't do that. You make up your shapes to make sure that you're making money on every ton that you're moving and processing, and that's your cutoff grade. So that's what the cutoff grade means. But currently, under the current 2012 JORC code, you don't have to apply the overlay of this is necessarily economic, which results in people, for example, quoting a 0.2 gram or I saw a 0.1 recently cutoff grade, which to any reasonable person would not be an economic cutoff grade. You won't be making money on a 0.1 gram per ton, processing it, digging it, the whole thing. So what people are doing, as Paul has alluded to, is by lowering the cutoff grade, they supersize their resource, but it's not necessarily economic. And so it to a degree, it can be misleading to the investor to say, hey, my resource has just gone from, 300,000 ounces to 700 or 800,000 ounces by just doing the famous desktop.
So would you
study.
expect this definition to change as part of the current review?
Yeah, look, what we're looking at, and I can say so because we've had the exposure draft out there, is that even at the exploration stage now, you're going to have to consider that what we call RPEE, or reasonable prospects of eventual economic extraction. We've removed the eventual. And you have to consider whether what you're reporting is reasonable in terms of an economic overlay. So people who want to use the smoke and mirrors of reducing a cutoff grade to make a resource bigger are going to be pulled up under the new regulations, but that's not for a couple of years. So it is definitely something to watch.
So cut away for a couple more years, get in while you can.
Yeah. But you should use common sense when you're reviewing these things. Yeah.
Yeah, look, I've always had a bit of an issue with this one, having spent a lot of time as a resource geologist. Applying a lot of economic factors to a resource, you're starting to walk the path of reserve, right? You're starting to put some cost structure around it. Now, I understand what JORC's trying to do, which is provide guidelines where there were none before. And I think that's really important for people to understand, is that's what JORC's about, is to provide guidelines for people to actually, report their information in a compliant fashion to a set of rules that have been defined by industry experts. And it's not perfect, but I think there is definitely, there's a lot to understand for an investor in the market to look at a resource that's been announced. And I'll use an example. I had guys putting open pit optimizations that were done by an engineer around a resource, and therefore restricting the value of the underground, which hadn't been evaluated, restricting those ounces from being publicised because they'd decided that using a pit optimization, because they were open pit miners, and there is an example that's close to my heart that I sold to somebody else. Essentially, they halved the resource because they used a pit opti, and so that left 500,000 ounces sitting in the ground that doesn't get talked about. Yeah. There's no reasonable reason why that wouldn't be economic, but they've essentially used a pit opti, and that's how they chose to represent the RPEE.
And there are instances, for example, underground, where if you've got an active mining area and you're going through some lower grade material, but you know that there's higher grade material in front of you, you will take that because if it's below your cutoff grade, you're going to have to take it anyways to go and get to that higher grade. So there are practical situations where you will mine below a cutoff grade.
Yeah, and I can't believe we've got 3 geos on the stage because we could debate most of these.
Yeah, actually, as you were talking, I was just wondering, the old joke about economists, ask 3 economists and you get 3 different answers. I think the same would apply to geologists. You get 4 different answers. Hedley, this might be our last one because we're up against a clock here. Not your clock, of course, but just the other clock. One of the expressions that investors love to see, I know it gets the juices flowing, is a VMS. Now, people might think it stands for a very massive system. You thought I was going to say sausage then. A VMS, a very massive system, and it's one of those things that's the holy grail in many ways, isn't it, for both explorers and investors. Give us a quick summary of what is a VMS, why do people love it, why do investors love it, and why is it considered, in so many respects, a holy grail?
Yeah, thanks for that, Paul. Bit of a hospital pass, actually, because there's one of the world's foremost experts on that deposit style at the back of the room, and he's grinning at me like I'm going to screw this up, and so I probably will. VMS stands for volcanogenic massive sulfide. So the massive sulfide just means sulfide minerals which contain metals, and they're massive. So there's lots of them. They're not little dots in the rock. You look at the rock and it's all sulfides. So that's what the massive sulfide bit means. The volcanogenic means that the deposit has formed by volcanic activity typically on the ocean floor. So there are parts of the ocean very, very deep where hot material is welling up from underneath, and the plates, if they're not moving apart, can sometimes be forced apart by the hot material. So it burns a hole or the fluids start to come through. These fluids, because they've come from deep down, are laden with metals. Hot fluids can dissolve huge amounts of metals in, and they typically carry a lot of sulfur. You mix that with seawater, it cools, and it causes a chemical reaction. So on the seafloor where these fluids come out, you start to deposit sulfides, and they just litter like dust, and then over a long period of time they build up into mounds, they get covered by other rock, and then they get forgotten about, they drift off into the ocean, and they turn up on land one day after they've been deformed and pushed up. So they can form quite large deposits, and the reason why I think investors, or geologists at least, like to get excited about them, but people who have found very productive VMS systems, they are deposits which have gone on for years and years. So Golden Grove is a great example in Western Australia. It has had decades and decades of mining. And part of the reason why they tend to go on for a long time is they are one of the systems that give up their secrets so very slowly. You find one pod, because that's where the smoke was coming out on the bottom of the ocean. That spot on the bottom of the ocean would have moved many, many times, and it would have built up many, many pods in some cases. It's difficult to find them, but once you're onto a system, you can sometimes find that you find more and more and more as you get into them. And they can be quite rich as well, just by nature of forming a massive sulfide deposit.
What a lovely note to finish off on. You find more and more, and they can be quite rich. I think that's a great note to finish it off. I'd like to thank everyone in our audience for attending to this fantastic milestone event for the Whole Truth podcast. The podcast is an initiative of Reed Corporate and Resource Media, and it's been a fantastic initiative. I think we've got a great following. Every week, so many of you tune in to hear our discussions with some of the companies, and it's one of the many ways that we endeavour to connect investors and resources companies, and it gives the people running the companies an opportunity to explain their story and what they're about. And I know from the following that we get that it's obviously very popular and much appreciated. I'd also like to thank a big thank you to our guests tonight, because to get three such experienced and qualified people in one place on stage like this to share their time and their experience is absolute privilege. Chris Cairns, thank you very, very much. Simon Lawson, you're always fantastic to us, and you join in. And Hedley Widdup, no more needs to be said. We appreciate your time as well. We appreciate all your time. That's the end of this episode. Thanks for joining us, and please enjoy the rest of this conference.
You've been listening to The Whole Truth, a Resources Rising Stars podcast, produced by Resource Media, hosted by Paul Armstrong for Reed Corporate. Please note that Reed Corporate does not provide investment advice, and investors should seek personalised advice before making any investment decisions.